I don't do the most, but I do a lot. I'ma make a toast, cause we still alive. No big, I feel like Pac. I shoot a shot. I'm coming in
Welcome
hot.
to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice.
Coming in
Listeners
hot.
should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, October 28th, 2022. S&P 500 currently sitting at 3,888. I'm David Zonning. I'm here with Pratty, Blue Moon, Tulsian, and Ian Barolo McMillan. I think right off the bat, we're going to go to Pratty coming in hot, shooting his shot. Pratty, I know why you're here.
Yeah, let's talk about small.
Yeah, let's talk about small caps. A couple of weeks ago, we were on here, all hands on deck. We talked about the things that we'd like to see from a bullish perspective, because sentiment was pretty negative a few weeks ago. Understandably so, because price was also incredibly negative going into that episode. But one of the items you brought up was a relationship like small caps versus S&P 500.
Yeah, so I guess one of the things we talked about was how whenever a bottom forms, no one really knows at the time if it's the bottom or just the bear market rally. And so right now we've got some sort of bottoming formation taking place, right? On October 4th, S&P ran up into supply at, around 3790. Now we're above that level. And we said one of the things that we could look to try and identify if this is going to be a sustainable move is if small caps are breaking out versus the S&P 500. And if you pull up a chart of, Russell 2000 versus S&P 500, today's candle is not ideal, but I'd say the behavior we saw this week is certainly pointing us in that direction. And especially with the fact that the S&P 500 is now above the June lows, seeing small caps outperform to the upside, there's certainly a lot of evidence out there that this could be a sustainable rally.
Yeah, for sure. And I think it's fair to point out that the relationship that you're talking about has a pretty well-defined horizontal level that you can look at on a chart and say, as long as it's above that level, the demand for small cap stocks outpaces the demand for S&P 500 like stocks. And we've seen it in the past. I mean, I'm not calling for this, and nobody on here should be, but the last time we broke above this level in a meaningful way was back in November of 2020. And those 3 months going into February of 2021, lots of stocks participating to the upside, very aggressive move. And then from a bigger picture perspective, there have been periods where we've seen small caps outperform in a much bigger way. Like when we look back to the correction after the dot-com bust, the move out of there was value in small caps. Maybe that's what we're seeing now.
Yeah, maybe it is. I mean, if you look at like a ratio of mega cap value versus mega cap growth, it's at its highest levels since February of 2020 on a weekly chart. And at the same time, if you look at NASDAQ versus S&P, that's at its lowest weekly close since April of 2020.
Yeah, good point. You're just saying that whether you're looking large or small, the evidence is here to support the thesis that value is moving higher on a relative basis versus growth. Is that a good summary?
Yeah.
Okay. And I find that fascinating, guys, that would be happening. And today we're having this huge aggressive move out of Apple.
Yeah, Apple's still hanging in there. So it still continues to be the lone mega cap growth name that hasn't completely just kind of had fallen out. Obviously we sit here and there's a lot of positive things to say about small caps and value. On the opposite side of the spectrum, large cap growth, mega cap growth, again, outside of Apple. So Google, obviously Meta and Facebook.
Well, no, that's a great point, because would you guys have guessed if Microsoft is down 3.5%, Google's down 5 or almost 6, Amazon's down 14, Facebook's down 24% on the week?
Mm-hmm.
Would you have guessed S&P 500 is green?
Probably not. I mean, those are some pretty big names.
So that means there's some pretty big,
pretty big components of the indices.
Well, and in
It does show
fairness,
the strength under the surface, and we haven't had too many big breath days. Now, I guess on Tuesday we did, the 25th, we had an 86% day, but nothing terribly dramatic to the upside. And maybe that's a good sign. Maybe if we can get out of the 80 and 90 days back and forth and get some more 60, 70, and obviously you want to see some higher numbers too there, but maybe we're going to see the volatility die down in a lot of these as far as breadth swings that we've seen this year.
yeah, for sure. And, and it just shows just how impactful Apple is.
Mm-hmm.
It's almost 7% of the S&P 500. Microsoft and Amazon combined are 8. That just gives you the size and magnitude of something like Apple that can cover up a multitude of sins that are happening from other these. Because there's definitely some, when you look at the FANG names, a lot of them, the mega cap tech stock names, do not look good.
They don't look good at all on an absolute or and obviously a relative basis as the broad market has rallied these last few weeks. Another update is if we were to close here and now, all 4 major indices would be back above their 200-week moving averages.
Hey.
So S&P never got below on a weekly closing basis. I don't believe, barely. Back in
October, early October.
Second week of October. But this would be a nice continuation bounce. Q's back over. This would be their first. Maybe last week was technically a close above.
Yep.
Week moving average. So continuation there. Dow, as we've talked about, a real strong relative leader as well as great as small caps in the Russell 2000 has looked. Dow Jones also not shabby the last few weeks on a relative basis.
Well, and why is that?
Large cap value, I guess.
Yeah, large cap value. Go ahead, Pratty.
United Health going out at a new weekly high.
Yeah, and that's the largest component.
Helps. And where would the Dow be if they still had ExxonMobil instead of Salesforce?
That's a great point. ExxonMobil
new highs this week, I think. Yeah, energy, obviously that goes to the value case. Areas like insurance have held up. Industrials continue to hold up very well, both large and small cap industrials. Aerospace has been a part of that, which clients will be familiar with. So there's some bright spots in the equity world. Now, is this another June, July rally? I don't know. We'll see. But certainly some good things happening again this week, which is great to see coming off of last week when some great things happened.
Right, and going back to what we've said on here in the past, and which Brad reminded us at the beginning of the show, was just right now there is a bottom that's being formed. Whether it remains the bottom is to be determined, but these are the types of things that you would see. Another thing that we talked about was just seeing bonds stop going down, which they did this week. We're finally going to have some positive weeks in things like treasuries. Now, they're not out of the woods. They're still in major downtrends.
Yeah.
But this is how you would see them stop. And maybe we pause here.
And I would say high yield carving out a little bit more of a bottom versus, when looking at treasuries. High yield kind of, if we're using J and K, bottomed like 3 weeks ago. So that could also kind of be some foreshadowing there. That would be a positive sign. Junk stopped going down before long-term treasuries, or intermediate term if we want to compare it to IEF.
And this pause in bonds really shouldn't surprise us, because Pratty, I know you did some work on, rates go hand in hand. Do you want to talk a little bit about what we were seeing from, 30-year yields?
Yeah. So, there's no doubt that yields are in a strong uptrend, but in that uptrend, for the most part, the 30-year bond yield doesn't tend to get any more extended from its 50-day moving average than right around 20%. So, you can go back to February, March 2021, you got about 20% extended. Same with earlier this year in April. And again, earlier this week, we kind of topped out right around 20% above a 50-day. And so this doesn't mean that, rates can't go higher, but at least in the short term, they've gotten pretty far extended from something like a 50-day. And that would suggest that, maybe they do have, some room to cool off before continuing higher.
Yeah, no, that it makes sense that they could just pause here, which would provide a reprieve. And that would be just this thesis of looking for credit and bonds to stop dropping so precipitously. Like it had been so sustained for so long. That's some of that, because there's many people, there's several technicians who would say it's not about the rate level, that it's the rate of change of rate, meaning when rates change, it might not be the nominal value of that yield. It might be the rate of change we've seen in that yield that really has impact. And so if you look at it from that perspective, we've had such a dramatic rate of change in the yield, right? That's kind of resetting the table of rules for equities. And so there was pressure there. So we'll see if that, how long rates pause, if they come back. There's obviously, we're Bayesian, we have to wait for more data to come in, but this would be a small step towards the bonds and credit need to stop falling thesis.
So I'm going to go out on a limb. I'm not calling, so maybe not going out on a limb. I'm not calling for anything, but I'm going to make the case here. We can pull up a long-term chart of 30-year treasury yields, and we can we've all seen this channel that yields have been in since 81. Obviously, that rate of trend has been broken. It was broken back in May of this year. We cruised through. Go ahead, Dave.
Oh, I was just going to say, it went through there in May and then retested in
we
July.
Got through the 3.4 area in October. And this has been such a dramatic move in rates off. If we go to March 2020, is that you could come back rates and retest this 3.4 area.
Yeah.
And staying with its rate of trend from the COVID lows, that could be we could see a couple years of falling rates.
Sure.
You could see us at 3.4 on the 30-year treasury in Q3, Q4 2024.
Yeah, I was just going to say, you could even be,
and maybe sooner, but you could definitely see at least the next calendar year of falling interest rates.
Or just interest rates that aren't going anywhere.
Or they're not going anywhere. We just bumble around in here. It changes nothing about the trend other than kind of, as Pratty mentioned, that we get off of this extended measurement when, if we use something again like the 50-day moving average.
When I know the dollar too was kind of in that same scenario where it was pretty well stretched away historically from the 200-day.
Yeah, that's had a big move since. That's really been going on since last summer.
Right. So you've had these moves that And the way to describe this, what Pratty's outlining here, is just when you move away from the average, the distance away can be like a rubber band that you pull. And there's obviously environments where that analogy breaks down and the rubber band snaps, such as to the downside in some things where you are consistently hitting extremes and the market doesn't care about this reversion to the mean. But we definitely seem to be in an area where that thesis could start to play out, where we see the dollar just kind of cool off. It doesn't have to have a major correction. It just could move sideways. Same with rates. And even though rates might not fall, if they move sideways, that rate of change dynamic that we talked about previously, that could be a healthy environment, right? Because that's basically the playing field of economics, is how much is money? How much does the money cost?
Well, and how relieved would investors be if, right, first step is just stop going up?
Right.
Yeah, so if they go sideways, I think I think a lot of investors would take that as a win.
Right. Well, and I think I gotta always be careful. Like, you use the term making a call, and you weren't. You were just saying, here's my thesis, which is how we operate here. I was just about to say, I think. But really comes down to, when we say that, we're saying what we're seeing in the chart. And an example of this would be, we just talked about rates. We just talked about the dollar. The dollar was weak this week. What would you think we would see out of gold this week? You would think you'd see gold move higher, and it's not. And that's information. When you see relationships like that,
This thing does nothing. Strong dollar, weak dollar.
right? Gold is still below a very important 1700, 1690 level.
Mhm.
And it can't even reclaim that with a weak dollar. That's worth paying attention to. It's worth, keeping an eye on that. And don't get me wrong, I'm not here to hate on gold bugs. I'm excited for.
Oh, go ahead.
I was just going to say, I'm going to be excited when I can be one.
And hey, gold bugs and other currencies had a decent year.
Very true.
American gold bugs, or let's say US dollar denominated gold bugs, tough, but Japanese gold bugs probably think they look like geniuses. So,
right, because they're owning it in the yen. And that's another thing, when we look at, yes, the dollar on a trade weighted basis paused. We had the Bank of Japan saying they couldn't really comment on whether they're directly intervening again. And really, that relationship, the yen versus the dollar, really that downtrend hasn't changed.
just another 1 day pop,
Right.
2 day pop, just like we saw in the end of September. So we're not out of the woods yet. There continue to be some great signs, again, like we saw in June, July, and in August, repeated out mid-August. I would say the same type of thing is happening now, and we'll see.
Well, it goes back to, it's not like we know what the next thing is that's going to happen. You just have a plan of probabilities. And we've talked about on here, and we talked about on the market call, Pratty's brought it up, you brought it up. If we're above 3667 on the S&P 500, or even 3674, which is the weekly close, that was a level you could take some risk on. You look at Bryce Harper's at bat.
And that was the June lows?
Yeah, the June lows.
Okay.
And that's where you can manage risk against. If you can take on risk, if that trade or thesis is wrong, you will know quickly, because you'll be back below 3667, and then you don't have to have exposure. It's very similar to Bryce Harper in his last at bat, where he takes. I'm sorry.
You would bring Bryce up?
It was a beautiful at bat. He put himself in a position to hit the ball out. Yeah, he took a slider.
He's having a really good postseason.
He took a 1-2 slider for a ball to put him in a 2-2 count, which set him up into a more probabilistic scenario where he's going to get a fastball, which he did, and he knocked it out of the park. So above that 3667 level is very similar. I have no idea if a fastball is coming, but I'm ready for it. And that was that level. And it could be the bottom. We don't know that, though. So what are you guys looking for that this would become the bottom versus a bottom. So let's take this thesis to the next stage of
I feel
analysis.
like it'd be the same as 4180, 4290, 4300, like 4300.
So you're just saying like on a horizontal level, support and resistance level on the S&P 500.
4180 would be big because you would I don't know how it plays out. Visually, I would assume you would be above the 200 day if you're, and I think we talked about this a couple of weeks ago. So you'd get above the 200 day. Are we major moving average people? No, it's just a great long-term indicator of what's, the broad market trend.
Yeah, who's got control over the last 200
And
days?
then obviously you'd want to see, it's greedy, but you want to see everything participate. Obviously, the small cap stuff is there. Biotech, energy, regional banks will probably do fine if this is the bottom. But like those mega cap names we talked about, those are still an issue, and they outweigh the good things.
Well, and let me ask you this though. So in the past as well, we've talked about,
in some sense they outweigh them.
Well, and here's where I'm going with this. So you had these big gap downs in things like Meta and Amazon, which were no surprise because we were already in downtrends.
They're in horrible downtrends, and you shouldn't have owned them in the first place.
But let me ask you this, because I want your guys' opinion. If those type of stocks just had their capitulation moment, what could that mean? They just stop going down, meaning, like, I'm not saying they're all of a sudden in an uptrend, but if they stop going down, that's at least the headwind gone, and you're neutral from those.
Yeah, there's no headwind. That is true. And then I guess you just assume that these energy, financials, industrials, I feel like materials is trying to get there, and you'll see pockets like steel was kind of had a decent run this week, and then got blasted today. Obviously, you mentioned gold not doing anything.
Well, what about you, Pratty? Like, what are the things from a thesis building standpoint? And again, everything is built off of, here's a thesis, like this is a bottom or the bottom, and if you were to see continuation, what are the things you would be looking at?
I think for me it's time, right? So we're in a bear market, and so I think really it's going to take time to form a bottom. And so what that could mean is, reclaim a 200 day and then maybe retest it from the upside. And then from there, on that next move higher, then you start to see, some of the stocks that stopped going down, those stocks also start to slowly participate in the rally. So, names like Meta, Google, Amazon, once they stop going down, and we know small caps have already stopped going down. They've, even been kind of trending higher a little bit. But if those stocks then join in on the next leg higher after we reclaim the 200 day, I think that could be something to point to as, okay, the bottom's in.
Right. Well, that's a good point too. You brought up bottoms take time to form, and recency bias would say that that's untrue. And I'm not actually saying it's untrue. I'm just saying recency bias. We've had so many V bottoms in the last 4 years that to be conditioned for this scenario might feel odd, but it's absolutely true. When you look through market history, majority of bottoms are not happening in a V bottom fashion. They take time to form, not as much time as a top takes, but they take some time to form. And in this case, it's given us a horizontal level to manage risk against. And this,
I have a question for you.
I'm ready.
Why do you think that tops take longer to form than bottoms?
There's two different types, right? So you get a top where distribution takes a long time for institutions to get out of positions without impacting price.
Like 2000 or 21.
Right, like 21, where they're continually distributing in a small fashion to get out without having price move against them so quickly. Now, that's a scenario of overwhelming supply. The other scenario would be a blow-off top type scenario where you just run out of buyers. And then the same thing on the flip side, you could make an argument when you look back at the COVID low that you just ran out of sellers.
Yeah.
That you had this exhaustion, right? That's an exhaustion type bottom. Whereas, you mentioned it before, this sloshing of breath that we've seen go on since June. Part of me sits there and goes, well, wait a minute, were those just days of massive accumulation that was happening? So like you pull up a chart and you look at the upside volume and you're seeing 80% and 90% up days, which were then subsequently followed the other direction. But were we actually seeing institutions step in here? So that's kind of a little bit of a long-winded answer, but there's two ways to form. But as far as your question is, why would you have a bottom that forms like this one?
No, I just meant in general, philosophically, why do you think tops take longer to form than bottoms? My answer
Got it. Go ahead.
Would be that the market has a natural bias to go up. People genuinely want the market, like people want the market to go up, right? I think everyone wants that at the end of the day. I don't know a single person that sits and cheers stocks getting crushed in 401. Now, we understand that happens. And as risk managers want to avoid those things. But I think overall, again, as we've seen since the day they opened, stock market over 100 years ago, the trend is up and to the right.
Right.
And so I just think people are more timid to sell and quicker to buy in general.
Well, yeah, the default setting would be economic and market expansion.
Now we get into here's the other side, which I've never been through. Not many people of either of our generations have been through, at least as professionals, is if we go into a period like the 70s, does that change? If we go nowhere for 14 years, 12 years, whatever it was, like 68 or 66 through 1980.
And so I have lived through that.
Change people's philosophy. There's this natural change because that was one of the longest sideways periods. We talk about up and to the right, and that is generally the case. And we can use 2000 through 2013 too.
Yeah, no, and that's what I was going to say. I did live through that. 2000 to 2013 was sideways for 13 years. And there's, when you go back through the last few years of S&P 500 returns. Now S&P is not all stocks. There's been plenty of stocks that have not had what I'm about to say. But when you have periods of 30+%, it would make sense to have stocks move sideways for a while. Right? Because you went from a period going into 2017, I believe the average annual return is around 7. And just in these few years, it's taken that annual return to 9.
Mm-hmm.
So a reversion to the mean of time where stocks move sideways for a while. And sideways can be from 3667 all the way up to 4,800 and then back down. And, that could take a few years and that would be 0% return for stocks.
Oh, up to where?
4,800.
Oh, Dave, why would you put that out in the universe?
Well, it could happen. I mean, you go up to 4,800 and you're there by March of next year.
Yeah, you could be there by March, April next year. Definitely, if this rips.
Think about you would have a 0% return and actually below that for many, many stocks. Like
Go ahead.
I was just going to say there's many, many stocks where it's going to be highly unlikely that they're getting back to their highs anytime soon. Like I think of
that is very true.
ARC Innovation, the stocks that are within there, right? We're in a 70+% correction in those type of stocks. They can rally.
It'll take years if Roku is going to get back up to 500, whatever it was. I think 500 or.
Right. These type of breakdowns and big moves to the downside, they take time then it's very, very, the less likely scenario is for those things then to rip higher, because even ARC moving up 30-40% from here only takes it back to like its June high. It's summer high. Like, some of this stuff is dead in the water. And I don't mean it needs to go continue a downtrend, but it's going to be an opportunity cost.
I mean, we could even go sideways. I mean, you have September 01 to May of 02. We kind of have this. I mean, if it's an extended, we got above the 200-day a couple times there. Or I guess those were both in 02, January 02 and March of 02.
Well, and really, when you look at the makeup of something like the S&P 500, and I apologize, I'm too myopic on that topic today, but it's going to be really hard for the S&P to just roll over if Apple's like leading. It just is. Yeah. And Apple is really it's the final piece. And it does make you wonder. We had that conversation 2 days ago. We've consistently seen these mega cap growth tech names break to the downside, with the one that hasn't, to a degree of significance, is Apple. I'm not saying it's not down. I'm just saying it's not in a scenario that Microsoft and Google and Amazon and Facebook.
Now, I'd say it's running into a big spot today. I would say this 156. I mean, it's had a good run, but like, that's the problem with bear markets, is you got to have a great run, and then you got to still keep going to get out of it. And how much energy, how much demand is willing to keep these going? Because to your point, you can push a lot of these stocks up 10, 15, 20% over 2 or 3 weeks. But then they're still, from a technical perspective, they're still not out of a hole. And it all fizzles up and we roll over again. And this 156 area on Apple, so 200-day moving average and a pretty decent neckline, I would say, going back to the September 2021 highs. It's an important area. We'll see if it can continue to push through.
Yeah, if you look at something like the NASDAQ 100, you could rally 7% from here up into a falling 200-day moving average, and you haven't fixed anything.
And you get another lower low or a lower high coming off a lower low.
Yep, and that's what makes bear markets hard. If this is truly a protracted bear, meaning this is going to last more months, years into the future. Which is that's an unfathomable thing for people to comprehend, that this could go into 2023 further. All this could be is a bear market rally. And so the reason why we even use technical analysis is we would have information to tell us when those scenarios are increasing in probability, right? So Q's above the 280 level, 283, that's would be a really positive and good development. Even better is if it's reclaiming its 200-day moving average, staying above something like 314, staying above a level like 333. Those would be characteristics of coming out of a true bottom. Otherwise, we're now in mixed territory. You can be taking on risk. That's not investment advice. That's just how we operate here, because we're above horizontal levels. But to say that, yep, for sure, this is it. That was the bottom. This is it. Everything in here should be 240% long. That would be incorrect, because the other things, we're still in a scenario of lower highs and lower lows with falling moving averages consistently. So I apologize, Pratty. I don't know if I missed it. Some of the things that you were looking for continuation, and you might have mentioned them, and I'm not remembering. Pratty, were there any things that you're looking for from a thesis of continued upside that you're thinking about?
No, there wasn't really anything else major. I'd say just, it doesn't have to happen this way, but I would like to see, small caps continue to outperform.
For sure. And we didn't even talk about, we talked about gold, but we didn't talk about other commodities. We didn't talk about cryptos. Anything you guys are seeing out of those areas that pique your interest?
Bitcoins, I mean, they haven't broken down any further. Copper doesn't look great today. And maybe it just, metals in general haven't been amazing. Yeah, I mean, Bitcoin above 21,000 is.
I mean, it is holding. That's an important.
It's closer to 20,300. Whatever we want to call these highs, and this early October highs, we'll call it.
Right. And when we look at sector rotation, if you're seeing a market bottom take place and heading into a bull market, the things you would like to see lead are technology, discretionaries, communication services, and industrials. And some of those have shown life. Ian, you mentioned industrials. That's an important development. I would say discretionary is hard because Amazon's such an overwhelming size there. But,
there's been some decent specialty retail looking under the surface within a lot of these smaller and mid-cap retail names. Not bad, which is also an area that you would expect to see. It's kind of a more risk-on area.
Mm-hmm. Like you look at small cap consumer discretionary like PSCD versus S&P, you can make an argument that a base has been building here since March. So that would be a 7-month base. We're breaking higher out of that. And let's just exclude Amazon for a second. Let's say Amazon is just in its own, right? And we should do that. We should take each chart on its own merit. If Amazon is in its own world, but yet we're seeing the rest of discretionary do really well, and we're seeing other technology things firming up, maybe this is the beginning of, from a sector rotation standpoint, right? Because like you look at something like PSJ, and it has a higher, its September low, PSJ being software, it has a higher low than June, and S&P didn't. And those are the areas that, like, when you look at, okay, how are you guys identifying strength? One of the simple ways is, was this area or was this stock, was its September low higher than its June or July low? And that's kind of information. And so we're kind of seeing that for sure out of things like energy, of course, but there's certain areas of discretionary for sure that had higher lows during that period.
Well, if you look at, speaking of relative relationships, look at small cap discretionary versus Amazon.
I like it. I like where you're going.
Weekly chart.
Yeah, look at that. Beautiful.
Just saying, if there was going to be a shift in like a longer multi-year shift here in the market, as far as, these individual retail names outperforming the mothership that is Jeff Bezos and Amazon, I'm not calling for it, but I wouldn't be shocked if it starts here or, some point here in Q4 going into 2023.
Oh, absolutely. And that chart seems to show that supports what Pratty was talking about, which is small versus large.
Yeah.
Right. If we're going to see small cap discretionary do better than large cap, or basically do better than Amazon, or if you're going to see small cap industrials do better than large cap industrials, that's important, really important information. And I would make the argument for the average retail investor, Amazon has this aura behind it of like, how could that underperform? I mean, everybody uses it. I use it every day. How could that possibly, like,
you want a reason I think it has that around that perception to it is because it's constantly used as if you had invested 10,000, right? You see this,
right.
And what do they always use? They always use Amazon.
Right.
Sure, it causes a lot of dip buying in the name too.
Well, and this goes back to when a stock becomes a utility. So using utility in its truest form, meaning like it's something you use in your everyday life. That's why we name companies that provide us energy every day a utility, right? Because that's something we just use. The lights are on in my office. I got 3 monitors. I got this mic. I got the speaker. I'm using energy. It is a utility to me.
Mm-hmm.
When Amazon becomes a utility, not in an energy sense, but this is what I use every day.
In a societal sense.
Correct. In a societal sense, the growth story is likely over. Right.
It's like boxes are getting
dropped everywhere.
Yeah, and that's
across
just I mean, that's capital. Like they're incredibly convenient.
And it wasn't always like that. It's the future discounting that happened to Amazon that forecasted the possibility of this moment where Amazon is used by everybody for almost everything. But
Businesses, individual,
but now that we're here, it's a utility.
Yeah, it's a great point.
Same with, but obviously maybe something's on the horizon for Apple that we don't know, because it's not showing that same.
Microsoft was utility for about 20 years.
Yeah, for sure.
In that same sense.
Yeah, no, absolutely. Well, and you saw it in its relative behavior.
Mm-hmm.
When you looked at it versus the S&P. From the year 1999 through 2018 versus the S&P, it went nowhere. So it definitely has periods of utility until it reinvents itself. And so will we see a reinvention of Amazon in some way? I have no idea. But going back to cyclical things that mark, right? You don't want to see defensives. What are we seeing out of the defensive versus risk on type area? Defensives being staples. Healthcare is hard because it's a mix. We've talked about that in the past.
I say staples are still they've been sideways on a relative basis for almost half a year now, since this summer, early May, April-ish. Utilities haven't been really good at all. They've pretty drastically underperformed over the last month, even with stocks not doing that great.
For sure.
And real estate still pretty gross. Relative bounce this week, but there's no reason to touch that. So yeah, as far as piling into and healthcare, I know you mentioned that, still pretty strong on a relative basis.
Yeah, it is.
Which I don't know, does like the biotech help out with that? I know we own some individual healthcare names for clients, and they've been quite strong. So,
well, and it's a market of stocks.
Yeah, exactly. That's a great way to put it.
There's some stocks that go up and there's some stocks going down. And this is an environment where both of those things are happening. It's not a correlation to one right now, where we are seeing certain areas of the market rise, certain stocks rise, while others are falling. And the reason why I use technical analysis is to identify those. And I hope those that are listening are really sitting there thinking like Sherlock Holmes and about the dog that didn't bark, which is, yeah, we talked about gold, but we talked zilch about commodities. And that's information too, from a sentiment standpoint, because simply commodities don't look good, with the exception of, even
I saw cotton was getting just crushed earlier. It's had a real nasty October, and October cotton looks pretty rough.
And that'll really actually be, one of the last things that will start. If we start seeing an expansion in market cycles, commodities will be the last thing to turn. That's typically how these work. So it's really credit and bonds first, then stocks, then commodities. So the downtrend in commodities could continue. And isn't that hilarious when the narrative is everything about inflation?
Mm-hmm.
Even though the charts are telling us inflation's already peaked. That's already done. And now are we going to see rates pause because the pivot's happening? Because I make the argument that the bond market moves first and then the Fed responds too late. That the Fed doesn't actually set rates within the bond market. It's the other way around. The Fed just reacts. And if we see a pause in rates here, that it would not be surprising to see some narrative that's about some Fed governor who says some crazy something about pivot or whatever. So we'll just continue to use price and price charts. We are getting close to the end of our time. Pratty, Ian, I always appreciate you guys being on here. Anything from you guys that you want to leave our listeners with, right? Any good presentation ends with the things you want them to remember. Anything that you want to highlight before we sign off for our listeners?
I guess I'll just say like there's definitely been a bit of a character shift here in the market. Now we've got two strong Friday closes in a row.
Yeah.
Both reversing out weakness from the Wednesday and a Thursday. So that's certainly a hopeful character change. That's good to see.
No, for sure.
I agree.
Completely agree. Ian, how about you?
I would just say that I agree with Pratty. And if we close, especially this Friday, if we close near the highs, this bounce off the 200 week, there's part of me is it a 1998 type of situation in regards to midterm year and what's been going on in the stock market. I would say that would be right. Well, knowing what came after 98, that would be great. I'd say overall market health, probably in a little bit different of a situation then. I've seen 98 as kind of a comparison that maybe some are hoping for. And heck, I would love another great 2-year run too. But when you look at overall context of what stocks are doing, I think we're in a much deeper downtrend than we were back then. That it was a quick one. It was I think it was around 20-ish%, but it was quick.
Right, it was quick, and
we were kind of able to V bottom out of it. I don't know if that type of behavior is as practical this time. Obviously, could definitely happen.
Well, no, and I think your point is extremely valid because there's plenty of shorts sitting out here ready to cover. We know that. And if that's upside fuel and that takes us into 2023, you could see a double top type scenario in something like the S&P 500 and the NASDAQ.
Can you imagine getting back to 4,800? The excitement there would be. Because we would at least for a day or two, we would go to new all-time highs for a day or two, I bet.
Yep.
And I mean, I'm a trend follower. I would probably be giddy as well. But and a failure coming out of that would just be the most just deflating thing.
Well, and what you would likely see in that, what you'd likely see in that scenario is you would see Apple start to underperform on a relative basis. It would participate, but it would start to underperform. That would be because it is really the kingpin of our time.
For sure.
Mark Minervini shared a great, and it looked like it was something that was maybe taken off of a screenshot off of a TV program, but it just talked about the different decades and the leadership out of those decades, like the 50s European stocks, the 1960s, the Nifty 50, probably not much unlike right now. 1970s, emerging markets and commodities, 1980s, Japanese stocks, 1990s, American tech, the 2000 emerging markets and commodities. We are definitely still in the mega cap decade with some soldiers that are down on the field. The ones we've talked about, Google, Microsoft, Amazon, Facebook. Those are some things that would be the kind of the first clues that you would see for some major type of top or end of a decade type scenario. Apple has to be that final piece. And right now it's not. It just isn't until price confirms that. Apple's still a tailwind for this market. So I appreciate you guys. You guys always bring the greatest stuff. Pratty, thank you for being on here. We always love your insights and the stuff that you provide to the team. Ian, like always, I really appreciate the effort you put in. And I know you had a lot of travel over the last 2 weeks with us. And
good. Got to see you guys 2 weeks in a row. So that was fun.
Yeah, much appreciated. And I know that and everybody on the team knows it's well worth it. And our clients are really going to love it. So once again, everybody that's listening, we appreciate it. Clients, thank you. People who listen, thank you. And if you love this, if you like what we're doing, please give us a high ranking. It helps us too.
Have a great weekend, everyone.
See ya.